In this week's video, we're going to have a look at some of the key issues that are facing markets at the present time. First, we'll touch on the global growth slowdown, then we'll look at some indicators in US recessions, and then we might touch very briefly on the Chinese currency. So just to kick it off, we'll look at the current state of global growth. Now, we use our measure of global growth momentum, and that's actually just showing here in the chart in front of you, the blue line. You can see here over on the right-hand scale, it's currently below zero, and in fact, it's been below zero since about the mid part of 2014 or late 2014. It's been a very gentle and gradual slide, not a sharp slowdown in growth momentum that we've seen in previous times. Why is that important? Well, we use it as for a couple of things. One, as an indicator of global growth rates more generally, and I'm talking about manufacturing or industrial production globally. So let's just add to that. We're going to add to that industrial production globally. Just make that change the scale here. And you can see here, this is the gold line, shows the global growth rate. So typically what happens is when this blue line, which is the momentum line, when that pushes above zero, as we saw here back in say 2013, the rate of global growth tends to pick up. And so what we've seen, as I mentioned already, over the past 12 to 18 months, it's been below zero, and global growth has been sliding in a very sort of slow and gradual fashion. So what's been driving that? Well, it's predominantly been, there's been a lot of talk about China, but where the big surprise probably is over the past 3 to 6 months has been in the advanced economies, and in particular coming out of the US. So if we add to the mix the US chart, just make that a bit larger, you can see US is a green line. This is industrial production 12-month change in the US, and that's slowed from around about 4% to about -1% at the moment. So it has been a key driver of this downturn in global growth. So that's fine, but what does it mean for equity markets? And obviously equity markets are already pricing in a fair amount of this slowdown. So let's just have a look at the global equity to bond market return ratio. We'll just adjust the scale here. And what we can see here is it has been a good long-term relationship between global growth momentum and the performance of global equities in local currency terms compared to global bond markets, actually using 10-year bond returns there, 6-month change. So the underperformance of equities compared to bonds over the past 6 months amounts to something like 12% as of January, and it would have declined further in recent weeks, is quite a sharp slowdown. We have seen these sort of slowdowns in the past. Typically, they've been associated with sharper downturns in global growth momentum, as we saw in 2011, obviously the 2008 period, and even back here in the sort of 2001 period. We have also seen other periods where markets have fallen quite sharply without a sharp decline in global growth momentum, 2002 in this period here. So what might lead to that? Well, we can see one observation to make is that clearly equity market performance, or this relative equity versus bond decision, is a lot more volatile than underlying economic growth. Markets tend to get a sniff of a change in momentum and price in a recovery or a downturn quite significantly, and perhaps that's what's happening at the moment. Or it might be that markets are adjusting to over or under valuations and therefore get sharp moves. We suspect at the moment that there's it's been driven by concerns of quite a more significant risk to the downside in global growth. So we'll have a closer look at some of these indicators of US recession, given that the focus is very much on downside risk to growth at the moment. First one I'm looking at is the ISM Manufacturing Index. We've shaded the areas associated with recessions. The series goes back to 1970 in this instance. So recessions have been generally been associated with ISM readings 40 and below, pretty much, as you look back at that data. What we also notice has been a number of occasions where it's been at the present levels in that sort of 45 to 49 region, 1, 2, 3, 4, 5, 6, possibly 7 if we count that one, where There hasn't been a recession. In fact, the US economy has been weak, but it's subsequently turned around. So currently, it is a concern looking at the manufacturing sector, but uh, still not totally consistent with a recession. If we look at the new orders series, which tends to lead the ISM series by perhaps a couple of months, it's more volatile, but it does provide a bit more of an update. And that too has obviously fallen to low levels, but showing a more encouraging little uptick in the most recent January data. But as you can see here, levels below 45 have been associated with recessions. Levels such as we've seen in recent times have occurred before, only to see a rebound. Back in 2012-13, we saw that downturn. Likewise, there in the mid 90s. That was around the bond market period. So we have seen a number of instances of the ISM new orders at these current levels. We look at the inventory pressure ratio, and that measures new orders and relative to the inventory index. So the idea is that new orders declining and inventories are rising. That's a bad sign, leads to further downs or production cuts and so on, recessionary type conditions. So a low reading on that index is generally associated with quite weak economic outcomes. What we've seen more recently, though, is a bit of a pickup in this one. So the new orders has been relatively steady, yet the inventory reading has been falling to lower levels. So inventories have been cut back in the past, say, 3 to 4 months. They were rising prior to that, but we think that there's been some sort of adjustment to inventories over the most recent months. So it's not consistent with recessionary type readings. Finally, I just want to focus on the initial claims for unemployment insurance, and we're going to look at it here in this chart form because it potentially is providing a sign of a turn in the cycle. So just to explain, the initial claims is the gold line right-hand scale, and it's inverted. So up here means a very strong labour market, and such as we've seen in previous cycles going back to 1980. The purple line is the ratio of global equities to global bonds. So rising means equities outperforming. So we've seen equities underperforming, particularly in the most recent period here, and the relationship between the two series has been, reasonably solid over a long period of time. So the fact that equity markets underperforming bonds, particularly more recently, if we add in more recent data, as I just did there, is suggestive of a turn in the, I guess this is an indicator of the US business cycle. So like we saw in the global growth momentum and equity versus bond chart, markets are already pricing in the potential for a significant turn. Finally, we just want to have a quick look at the concerns over the Chinese currency. So the chart in front of you is showing, the red line is FX reserves in China, and they've dropped over the past year from around about 3.8 trillion to 3.2, so a $600 billion US dollar drop in FX reserves over the past 12 months as they seek to support or meet the pickup in capital outflows. Now, China received something like 450 billion in a combination of the current account surplus plus foreign direct investment. So the decline in reserves suggests, and the data is not that transparent, but suggests that capital outflows plus valuation adjustments have amounted to something like 900 billion over the past 12 months. So that is a concern, and if that continued at that pace, then the FX reserves of China would reach the sort of $2.6 trillion level that the IMF has recently said would represent not so much a critical level, but it's certainly a level beyond which there would be significant concerns. And so that would occur in 12 months' time if capital outflows continued, or less than 12 months time if capital outflows continued at the more recent pace. So what the couple of other issues for the currency. One is the real effective exchange rate for China, as we know, has increased quite steadily since 2006, and since 2012-13, it's had quite a sharp rise. against, as this suggests, against a basket of currencies. Over the past, say, 6 to 8 months, it's been relatively stable on a trade-weighted basis, and this is the way the Chinese would appear to be managing the currency now, trying to stabilize it against a basket of currencies, but it would appear to be still at a relatively high level, and with the economy slowing, the pressure remains for further weakness in the currency over the period ahead. Looking at the yuan against the US dollar, you can see that we've had periods of stability followed by periods of weakness, slight or devaluation, as we saw back in August. There has to be some ongoing pressure for further modest weakness, perhaps in the same sort of pattern or fashion that we've seen over the past couple of years.